Welcome everyone. On Friday, the House passed the $2 trillion bill. I spent most of today digging into the major sections of that bill and put together this presentation to go through some of the key bullet points that hopefully explain how the bill may impact you directly. There is certainly a lot to unpack, but you've probably heard some of this already speculated in the media. It did come to fruition, so there are going to be direct cash payouts, which we'll certainly touch on. There are rules, special rules, in order to access retirement funds, 401k plans, as well as impacts on the required minimum distributions. So qualified plans got quite a bit of attention. And we're going to close out by talking about charitable contributions and some of the rules that were changed related to deductions. Okay. My name is Rick Vazza. I'm the president of Driven Wealth Management, a San Diego firm that helps our clients with financial planning and investment management. Our goal is really to help them gain clarity, control, and confidence as they grow and protect their money. I'll be the host today. Certainly a lot to unpack, but for those of you that stick with us through the end, I'll also have some resources available to hopefully help as you absorb a lot of this information. All right, so we'll just dive right into it. As mentioned, kind of one of the major headline pieces is the direct cash payouts. Those payouts will be determined based on your tax filing status. So individual tax filers, it looks like, will be receiving $1,200 for the month. Joint filers would be $2,400, and there is a child credit for $500 per qualifying child. Now, don't let that picture fool you. Important to note, qualifying child are dependents, often of which these are into their late teens and early 20s. So it's important, and there's certain metrics that need to be hit. Importantly, there are income phase-out limits for these cash payments. The two important thresholds to be aware of are $75,000 for single filers and $150,000 for joint filers. So as your income is above that threshold, the payment you receive, if any, will be reduced on a gradual basis. Also important to know, payments are going to be sent directly to your bank account if you have your banking information on file. The easiest way to know so would be if you had filed, and received a refund for last year, what bank account that refund went to, or if you owed money, how that payment was made from which account. That information that's on file is going to be the bank that receives these payments. So really important to make sure that that information is up to date and accurate. If you've made any changes, make sure that those have been adjusted for the most recent filings. If you don't have bank information on file, the payments are going to be mailed. So certainly would be worth your time to get this information updated, because I imagine those mail outs are going to take a lot longer than the direct deposits will. So I think one of the most important things you can be doing in anticipation of this cash payout is really getting an understanding of your current spending plan. And I'll have a spending plan available to those of you who are interested at the end. But I think this is a great opportunity to really go through and assess your current financial information. Look at the last 3 months of credit card history, really understand where your money is going. So that way, when this payout comes to you, you have a game plan in place with exactly what your intentions are with that money, right? Is it going to go towards paying down high interest debt? Is it going to go towards an emergency fund, investing, everyday expenses? What exactly will you be doing with that money? Having a strategy in place beforehand will just really give you confidence and make sure that you're utilizing this money to the best use, right? So that's something that you can certainly be taking advantage of, and I would encourage you to do so. And like I said, I'll have a spending plan template available if you're interested. So I mentioned in the opening, retirement accounts got a lot of attention through the bill. The first of which is actually accessing pre-tax retirement money that's in an IRA, so an individual retirement account. So you're typically going to be traditional IRAs or rollover IRAs. Now, Normally, if you were to access that money prior to the age of 59 and a half, you would not only owe tax on that money, but you'd also have a potentially 10% early withdrawal penalty on that money as well. So with this new rule, there is going to be a waive of that 10% penalty for any distributions up to $100,000. Now, important to know, it's not the tax getting waived, just the penalty getting waived. So you will still owe taxes on those distributions. The rule has also made a special accommodation for the tax payment. Now, normally, let's say you were to take that, let's just say $50,000 from your retirement account in 2020. Well, come 2021, when you're filing your taxes in April, you'd owe taxes on that full $50,000, assuming all of it's pre-tax money. Well, what this new rule is going to do is, instead of having it all due the following tax year, you're going to actually have the opportunity to spread that payment out over 3 years. So it's going to help alleviate some of that tax burden that could come if you do need to tap into these retirement accounts. Also, what they've done, normally if you take that money out, let's say you had a short-term cash crunch where you needed to access this money, typically you have 60 days to get that money back into the account, where the IRS basically views it as, hey, you never even took the distribution in the first place. It's a 60-day rollover to get that money back in. In this case, they're actually also going to allow you 3 years. They're extending that 60 days to 3 years, where you have 3 years to get that money back into the retirement account. That's really important. So anyone who's thinking of that they might need to tap into this money, but they're concerned that they're going to be setting their retirement back, really derailing their retirement plans, this is going to allow you some potential opportunity to catch back up. Right? If you do need to tap into that money, hopefully now over the next 3 years, you have an opportunity to really be building that savings back up and potentially put it back into the account and catch yourself up. So it's nice that they allowed that opportunity to an extension on the repayment. Obviously, you could probably quickly see how this could get confusing, right? If you're paying that tax payment over 3 years, but you also have 3 years to get money back into the account, will those things be offsetting? How exactly is that going to work? You can quickly see how there could be some confusion there. That's why it's going to be really important that you document effectively, with that money coming out, and working very, very closely with your accountant and tax advisor to make sure that you're doing all of this effectively, and most importantly, accounting for everything, because you could quickly see how that could get a little confusing. So work closely with them, but it is nice to know that they have made some special provisions in place if you do need to tap into that long-term retirement money. Additionally, for those with active 401k plans, not necessarily looking to withdraw their retirement account money, but potentially access that money through a 401k loan, normally that limit was $50,000 as far as funds that could be accessed through that loan provision. The new rule has increased that provision up to $100,000, so gives a lot more access to funds, essentially doubles it. And then also, you would normally be required to start repayment of that loan, as well as interest on that loan. That has been extended up to a year. So those, it looks like, will not be starting until 2021. So it gives some flexibility as far as that repayment if you are to take a loan against your 401k. Now, hopefully you don't have to access your retirement accounts at all. Certainly that's often going to be a last ditch effort, and one of the things we would strongly suggest trying to avoid at all costs from a financial planning perspective. But these are unprecedented times. It can be difficult, so it's nice that they've incorporated these rules to allow people to access the funds if they need to. I mean, especially given the market pullback, hopefully this is something that you're not having to tap into, but just know that these options are available if you are in need. Now, last thing related to retirement accounts, there is a temporary waiver of required minimum distributions. So those of you who aren't familiar with required minimum distributions, with traditional IRAs, any pre-tax money is pre-tax. You haven't paid any tax on it. So that money has been deferred on an ongoing basis in those retirement accounts. And eventually the tax man's going to come knocking, right? You're eventually going to have to pay tax on that money. So required minimum distributions are when you hit a certain age, the IRS actually requires that you take money out of those accounts, and those distributions then are going to be taxable, as that money comes out. So what this waiver is doing is actually it's going to be waiving the requirement to take that. So it's nice, hopefully alleviate some of that tax burden. Right now, those required distributions are required to start at age 72, attaining age 72. That was a recent change that was put forth with the recent passing of the Secure Act. So previously, it was 70 and a half. So we got a little alleviation from 70 and a half to 72 with the Secure Act. We got even more alleviation with now the temporary waiver of the distribution altogether for 2020. Important to note, this does also include inherited IRAs. So if you received an IRA, if you were the beneficiary of that money, you would have typically had to take required distributions as well. So it appears that for 2020, you will also not have to do that for inherited accounts. For those of you who this information applies to, fantastic opportunity to talk to your tax advisor and discuss Roth conversions. So, this is money that you normally would have been paying tax on anyways as it came out of the account. So if you potentially are in the fortunate situation to do so, maybe it makes sense to talk to your advisor about potentially converting that money, paying the tax, but instead moving it into the Roth account where it could have the opportunity to grow tax-free. That's going to be a case-by-case basis. I'm also going to be doing a session specifically on Roth conversions. So if you're interested in learning more about those and the ins and outs of a Roth conversion, definitely be sure to follow our page. I'll give you more information on that at the end of the presentation. All right, and coming toward the end here, one of the best things that I've heard through this difficult process that COVID-19 has presented to all of us is some people in really fortunate financial situations asking great questions of how can I best help? And this new bill has provided an increased benefit to those who are charitably inclined and in a position to do so. Now, normally, when you make a cash contribution to a charity, you are able to deduct that donation from your income, but there is a cap on that deduction. Well, this cap has been removed with this passing of the bill, so you are literally now going to be able to get a dollar-for-dollar deduction for any cash contributions. I mean, that can be taken to an extreme. So let's say you made $1 million of income for the year, and you also have $1 million that you're able to donate to a charity. Well, if that $1 million is a cash donation to a qualified charity, you're going to be reducing that taxable income dollar for dollar all the way down to zero. So you can see how it's very powerful. Important to note, again, that is only cash donations to qualified charities. So that is not towards a donor-advised fund or a private foundation, which are common financial planning vehicles. I think the reason for that is the bill is trying to get this money to the people that need it as quickly as possible. And they don't necessarily want it going to a donor-advised fund or a private foundation where that money might sit there, and grow over time. They want it moved aggressively to these charities as quickly as possible. And the cash contribution, of course, is the fastest way to do so. So those other ones still will get their normal deductions as far as the donor-advised fund or private foundation, but they will not receive the full benefit that is only being awarded to direct cash contributions to qualified charities. So important to know, great way to give back, and as I mentioned, I've been hearing some great questions about people looking to make those contributions. So I know we unpacked a lot here. This is certainly an uncertain time. A lot of questions, a lot of people concerned over their finances. I'm really excited. We're going to be launching on April 8th a personal finance workshop. There's going to be a class with 2 live sessions per month. I'm very aware of everyone's budget constraints, so we've made this extremely affordable, only $47 a month. Those of you who are interested, I'd encourage you, please reach out to us, trying to empower as many people as possible through this online process. I think it's going to be really exciting. We'll certainly make it informative, but we'll also have a little bit of fun along the way. As I mentioned, those of you interested in the spending plan template, please email me directly. Just let me know. I'll be more than happy to make that available to you. And we're also going to be providing a lot of information, so I'd encourage you to follow along. Our website's drivenwm.com, where you can sign up for our blog, where no spam, just quality, free information directly to your inbox. And also a recently launched YouTube channel. We'll be doing more video education similar to this. Certainly, I hope you found this information helpful. We're going to be uncovering more information probably on an ongoing basis, but I wanted to get this information out as quickly as possible, hopefully to hit some of the major bullet points so that you have the information you need to really make informed decisions moving forward. Again, thank you for joining us. I really hope you stay in touch, and we'll look forward to talking with you again very soon. Thank you.